Hello and welcome to Securities Lending Saturday. I'm Roy Zimmerhansl and I'm your host. I'm going to be talking about something that the SEC in the US has just brought to light. They're concerned about transparency in the securities lending market. So this week and next week, I'm going to be talking about just that point. I'm going to be talking about trading transparency in securities lending. So if securities lending is your thing, if you're a lender, a borrower, an intermediary, or part of the ecosystem, or maybe you're just interested in learning more about securities lending, then this is the place for you. Let's get started. Hello, everyone. It's another Saturday. As I said, I'm going to be talking about trading transparency today, a super timely topic. And I'll give you my views on the infrastructure, the issues, the challenges it raises, and I'll give you a few comments on the SEC proposals, which I will refine over time, no doubt. But this is a short consultation window, so we've only got a few weeks to actually make our comments known. Again, many of you will know that you can download the slides from this series, and this is the location for it. So it's just bit.ly/SL Fundamentals, spelled like that. So if you are interested, and we had quite a lot of people sign up after last week's short selling episode. Always looking for more viewers. And remember, if you like these videos and if you think that they add value to you, please give us a thumbs up, depending on which platform you're watching this on. We really appreciate it because that way we also know which videos work the best for you, which ones give the most information. As always, I've got my slide deck. Here we go. If you're out there, I know I need a producer, but I'm waiting for someone to volunteer. So if you know someone that wants to be a producer of this show and learn and participate in this, then just get in touch with me. Today, trading transparency. Next week, we'll be looking at things like voting. We'll look at taxation. Again, several different aspects of transparency. Today is just trading activity. Okay, these are the topics we're going to talk about. So first of all, we're going to define what is market transparency. Then we are going to look at definition of market depth. And what I'll do for each of these topics is give you the explanation of it and then go into what my assessment is of securities lending. First of all, the key relevant issues, and then the bottom line in each of these items. As it says at the bottom, as soon as I clear the caption, it's for information and for entertainment purposes only. Always talk to a professional before you get involved with securities lending or indeed anything involving financial markets. Again, let me just repeat, if you like this, subscribe. We are well on our way to halfway of the qualifications that we need, but we need 500 subscribers to be able to get to an area where I can put up a community site. We get more and more questions from viewers every week, and I love engaging with that. I can do a lot more if we can get to the community page of the YouTube channel. In order to do that, we need to get to 500 subscribers. I think we are between 350 and 360. So we are a good part of the way there, but I need your help. If you like this, please show it to someone else that you think might also like it and let them make up their mind whether they want to be a subscriber or not. I put my glasses on because we're going to talk about definitions today. I've taken two different definitions, one from Wikipedia, one from Investopedia, one because Wikipedia covers more markets. The second part covers more investors. So the bits that I've highlighted in blue really talk about what market transparency is. So as far as the definition goes, it's really about what products and services are available, the market depth or how much is available to trade, the price it gets traded at, and where you would trade it. And as the final sentence says, these are really important requirements in order to have a free market that is completely efficient. So you can have free markets that aren't efficient, but ideally you'd want to have it be as efficient as possible. The reason I put in the second one in particular is it talks about the various fees that people will be charged to process them. Okay, so again, that's an important part of the considerations here. The recap, The reason I'm doing a recap on securities lending is because when people talk about market transparency, often they're comparing it to cash market executions. And while I understand that at a surface level, you could say this is no different, whether you buy or sell a stock or borrow or lend a stock, it's the same thing. Why not have more transparency? And while at the top level, I can see that practically that doesn't apply here, in my opinion. So I want to actually give you some of the reasons why. Remember, securities lending is all secondary market transaction. So the need for a loan or a borrow is driven by something else. So that might be a short sale, in which case, indeed, you need to borrow the securities to cover the short sale, or it might be a collateral exchange, what we call collateral transformation. So again, that's what creates the need to borrow and lend. But in and of itself, securities lending transactions don't just happen organically. They need to be driven by something else. And very different to a normal cash market execution, securities lending creates ongoing credit exposures. So borrowers over collateralized, lenders, even though they're over collateralized, market conditions can change, markets can become volatile, prices can change, and they have potential credit exposure to intermediaries. So that's very different from an execution where you just do it, and once the trade is settled, that's the end of the transaction. Now, because the continuity of securities lending is really driven by the ability for investors to substitute. So a lender who lends a security today isn't committed to lending it tomorrow. They can close out that position, and a lending agent will substitute another client for that, or a borrower will have to go to another agent. Now, while that's a good thing, it also creates levels of complexity. Number one, the complexity is that each and every investor is different. They have different credit appetites, they have different approval levels, they have different counterparty assessment processes. So there's many variables in that. And in any case, even though there's a full stop missing after the word institution, fewer than 20% of investors lend their securities. And even the ones that do lend don't necessarily lend them to every borrower in the market. So what you already have at the beginning is a constrained market. This is a small proportion of the total free float available in securities, be they equities or bonds. So you're already starting with a smaller universe, and even that smaller universe doesn't deal with everyone else, right? Now, one of the reasons that they don't deal with anyone else, part of it, of course, is credit approvals. They may not be able to get credit approvals. If you're a lender, you may not get credit approvals for all the borrowers. If you're a borrower, you may not be able to do the credit work involved with assessing thousands of beneficial owner investors that make their securities available for loan. So there's an element of credit exposure, but also just an element of work and prioritization. So those things add challenges to the process. Securities lending is also a cross-market, cross-asset, cross-currency business. And so that adds additional risk because of volatility could be compounded by multiple movements in multiple markets, but also makes the credit assessment more challenging, and also the investor criteria, which is variable, as I've said before, also becomes more complex when it goes cross market. And even if you get rid of the cross currency environment, if you only look at the US, you still have all of the investors differentiating themselves. They may not want to lend to every borrower, and not every borrower may want to borrow from every lender. Because remember, borrowers have a real ongoing exposure to lenders all the time because they're over collateralizing, whereas lenders only have a potential exposure to borrowers if there's a default and market volatility goes against their over collateralized positions. Now, the complexities of the work, the actual business, the processing of the transactions, and then the credit implications means that usually end lenders and end borrowers use intermediaries in the middle. And those intermediaries, whether they're agent lenders or prime brokers, they add another layer of transaction processing and additional, what I've called here, business discrimination. What I mean by that is a selectivity of who you will deal with and under what terms you will deal. And then also finally, the current business models that an agent lender or prime broker use might impact the loan pricing of transactions, and in fact whether there's a loan to do at all. So there's some agent lenders that only lend out relatively high priced securities, so securities that are in a reasonable amount of demand. And what that means is that the residual amount of supply isn't available to the market just because economically it isn't worthwhile. And so you have this universe, which is constrained by the number of participants, further constrained by counterparty selections, further constrained by business models. So this really, to me, doesn't reflect cash markets really in many ways at all. And so that calls into question the demand for greater transparency on price. But I'll come back to that. Let's look at market depth. So market depth talks about the measure of the supply and demand for liquid tradable assets. There's a reason that I've highlighted that, because as you get into OTC stocks or less liquid securities, bid-ask prices widen, and there may not actually be a commitment to execute at those prices. So for parts of this presentation, I'm going to concentrate on what are liquid tradable assets. And as it says here, the greater the quantity of the orders of supply or demand, the deeper or more liquid the market is considered to be. Now, remember that for the most liquid securities, you're going to have the tightest bid offer spreads in there. And so the revenue opportunities, the spread that traders can make on that are reduced. And so some people don't trade it for that reason. And the question could also apply to securities lending. If the spreads are so low, because you have this super efficient, super deep and liquid market, will people participate? And we know for a fact that today already, because of those business and economic concerns, many people don't participate in the most widely available liquid securities. I'm not convinced that hurts the market, because whether a new lender comes into the market and lends their Apple shares or not makes no difference to Apple or any other potential investor, be they long or short. So let me just compare securities lending on this particular issue of market depth. One is looking at the supply side and the demand side, and then the other question is dividing it into the pre-trade and the post-trade. So what do I mean by all of this? First of all, when a short seller wants to short sell a security or put an order into short sell, they, in many jurisdictions, need to satisfy what's called the locate requirement, where they can do an assessment of the market and determine whether there's a reasonable chance for them to be able to borrow the securities in order to execute the short sale and be able to deliver on settlement date. Now, practically, and I've done other videos on this, so I'll include a link here. Practically, what happens is the prime broker intermediaries get feeds from all of the agent lenders that they deal with, look at the portfolio totality of each position, do a subset of that figure because they need to be certain it's those positions are reasonably stable and they can confidently borrow those securities, do that extract, distribute it to their clients. And so the prime brokers are pushing the availability of the supply to the potential short sellers. Now, in addition to that, sometimes short sellers will want to trade more than the position that they're shown, or they want to trade securities that aren't shown by their prime broker. And that's really the pull. So the short seller is calling up their service providers saying, please give me information, go do a search and tell me how much of this I can borrow. Then once they've actually done that, then you get into the trading side. And then once they've satisfied themselves that they can access it and satisfy the locate requirement, then they're free to short sell as and when they find it opportune. So if we stay with the pre-trade side of things, if you look at that demand side, so the supply has come to them from their prime broker. The demand side, we call these things many different things, right? So if you have a really widely available blue chip stock that is core to most people's portfolios, and there's a lot of availability of supply to lend, it can be called general. In these prime broker files, they're often called good to trade files. So you can just go ahead and trade them, or it can also be easy, meaning easy to borrow securities. So to me, those are what I would consider to be the liquid tradable assets that was referred to here in terms of market depth, because there you have plenty of supply whatever demand there is can be satisfied, and there isn't really a lot of complexity to it. And the price variation, which I'll talk about in a minute, is very low. But these hard to borrow or specials or even warms, all of these things, what that means is that the demand to borrow these exceeds the supply. And so that creates an additional challenge. And so the market depth of those is going to be relatively small. By definition, you're saying that the supply is short here. There isn't much of an order book. Otherwise, you'd be able to go out and borrow it, and it would be a good to trade security. And remember, these are the securities that are in most demand by hedge funds or the end borrowers, even retail investors. And so there's a huge amount of demand for these assets, and that scarcity value itself, not only does it impact the price, but it also impacts the tradability. If everyone was doing that trade because there was enough supply, there might not actually be a trade in there. So you change any of these factors and it changes the whole picture. Now, if we look at the pre-trade side, so a short seller has got the securities, or they know that they can satisfy the delivery requirement in all likelihood when it comes to trade. You can see that the good to trade files, you can just trade away on that. So the demand side or the pre-trade side of things is really covered off. How does it look in the post-trade world though? So when a lender shows a borrower a position, that means that it should in theory be available to that borrower. And while that may be true at a macro level, where an agent lender will aggregate all of their availability from all of their clients that have approved the borrower that they give that information to, at an individual client level, they may sell the securities. So it was available today, but it's now been sold out. So maybe there isn't that supply. Or maybe it's available and they could do the loan, but the borrower has reached their credit limit with that counterpart. And so you also don't have a loan. Or maybe there is a loan available from a client where the borrower hasn't approved it. So remember, the lender is sending to the borrower everyone that will lend to the borrower. That doesn't mean the borrower is willing to borrow from every one of the lenders. So while the securities in theory are available, it doesn't mean that when push comes to shove, when you actually need to execute a trade, that it really is available. Now, the trades themselves, they can be bilateral or via platforms. I've got a slide on that in a minute. And again, all of this is dependent on the stability of the positions and the credit relationships with all of those entities, but also the practices by the investors. So maybe the securities are available, but maybe that investor is an active voter of their shares. So they'd be willing to lend it, but they automatically recall it when you're coming up to any kind of voting period. Or because borrowers are required to substitute dividends if a loan goes out over a dividend period, and they have to make up that money to the lender so that the lender is whole in the same position that they would have been had they not been doing lending. Maybe that lender's dividend profile, it makes the stock too expensive. And so there's a huge number of these sorts of real minutiae and nuances that change the picture. And then the final point on the supply side is that the cost of lending impacts the loan price. So a smaller transaction in a stock will generate potentially a much higher fee, right? Because the settlement charges involved in moving those securities might be quite high. So moving $100 worth of stock as a proportion on the fee side compared to lending $1 million or $10 million of that same stock is huge. So you could have a stock, two trades in Apple shares, a really widely available stock, one at an extremely low price and one that would look ridiculously high priced because it represents a small transaction size, and therefore the settlement charges associated with might be very high relative to the value of the loan. Okay, so that's just on the size of the transaction. Collateral, I'll talk about in a minute, where the collateral types have an impact on the business or the transaction costs. How the intermediary indemnifies a client if that's provided. There's different ways, and that agent lenders do that, and those different ways carry different costs. And then ultimately it's a matter of cost. So even if it looks like securities are available, it doesn't mean they're available to you if you are the end borrower. Now, if we look at the demand side, people are looking to borrow securities because of new trades, obviously, or maybe it's because they have an existing loan outstanding and they've been recalled. Someone's asked for the shares back, so they have to borrow it to replace it. So that's not a new transaction in the market. That short sale or that collateral transfer, that's already been done. And so this is really to substitute it and exercise that continuity I referred to a few minutes ago. Or it could actually just be simply a fail on a long position. So this involves no short selling. This is just a client made a sale and for whatever reason can't deliver the securities, and you may be looking to borrow to cover that settlement fail in the market, maybe to avoid a buy-in. And then the other comment there, which I skipped over, which is refinancing. So let's say I have 5 loans outstanding or 5 borrows outstanding, each of 100 shares. I might refinance that into a single transaction of 500 shares. So again, I'd be closing out 5 by 100 and putting on a new loan of 1 by 500, and that might make more economic and management sense. So again, that's not necessarily a new transaction. But the low demand, high supply stocks, there's already no touch automated executions in most of those cases. So that's already, to me, a really liquid tradable asset. And I'm not convinced that publishing any information on that really adds anything to anyone. And the high demand stocks, of course, as I've said, I consider those to be relatively illiquid. That's why they have high prices. And so you're almost saying there's low order depth. Of course, there's low order depth. If there was already a lot of supply there, you wouldn't have an issue. So even if it looks like there's supply, that doesn't mean that there is supply available, and that supply is not necessarily available to everyone. And the high demand stocks, by definition, are high demand because there isn't much in the market to begin with. Because again, fewer than 20% of institutional investors by asset value lend their securities. Let's talk about price. Price transparency, as says, typically refers to the extent to which information about bid prices, ask prices, and trading quantities for a specific stock are available. Let me go through some of my comments here. So the securities loan transaction price isn't really a price. And what I mean by that is the fee that gets charged is a combination of factors, because if it's collateralized by cash, so wait, let me stop. Everything starts with the intrinsic value of the security. What's the relative figure of the supply of assets available for loan and the demand to borrow those assets, right? That's the question. So that's where you start with. Then you look at it and you say, what kind of collateral does a borrower want to give, or what kind of collateral does a lender accept? And so if it's cash collateral, and again, there's other videos I have on this, if it's cash collateral, then the lender will take it and reinvest it. And 2 different clients might have 2 different appetites for reinvestment risk, and therefore they're taking cash, generating revenue off of it, and they may give different lending prices to the borrower for exactly the same stock, for exactly the same size, with the same dividend profile, but 2 different outcomes because their return might be high. Now, that's not something, that price, but that's not available to anyone in the market. If they see one stock going at 20 basis points and another stock going at 10 basis points, they'll go, why is one twice the size of the other, twice the price of the other? And that's because of individual choices that aren't transparent to anyone and can't be made transparent to anyone, because you can't get to the level of, in theory, you can do anything, but it wouldn't really add value to get to the level of disclosing what the investments are, just like no other investor publishes what they do live in real time themselves. Asset managers just don't do that. And the regulators don't require them to do that. So I don't see why it would follow that they could do it here. If it's non-cash collateral, so other securities, stocks or bonds, then again, even within that, there are different ranges that different investors will accept. Some will take a wider range of non-cash collateral. Some will take a narrower range. And both of those then have a cost impact to the borrower in terms of opportunity cost. If there's a really high form of collateral that a lender, that's the only thing they'll accept, well, the borrower has to say, would I rather allocate it to that lender, or do I have better uses for it organizationally? And maybe I do. And if I do that, then I have to find a different lender somewhere else. And so even if I do decide that I'm going to give this high quality asset to that lender, my cost, my opportunity cost for using that asset is going to be higher. So I'll pay a lower fee. Again, if you just publish that information, that won't be obvious to anyone. No one will know that. It might look like it's a mispriced transaction. And I'm not certain that adds value to anyone's decision. And of course, sometimes borrowers do bilateral collateral and sometimes they do tri-party collateral. And I'm going to do a video on that in the next few weeks. And that's very much thank you to Amal, who is one of my viewers and subscribers who suggested that. It's a great idea, and I will go into that in a few weeks. So thank you for that. So again, borrowers have different cost profiles if they have to put collateral into tri-party as opposed to bilateral. Now, of course, there's other benefits to tri-party. That's why they are so dominant in their positions. So everything is trade-offs here. Now, the other thing about securities loan transactions is because they have a lifespan to them, they're also negotiable and renegotiable throughout the life of a loan to reflect the different supply demand dynamics and other factors influencing the pricing. So again, unlike an execution, if something is worth 10 basis points on day one, it might be worth 100 basis points 30 days later. And again, so what does that tell you? And then finally, and this is by implication, one of the factors that talks about business models, this is where the lending agent intermediaries, they absorb all of the transaction costs on behalf of the lenders. And of course, they carry on the maintenance. For them, it's an economic decision about the size and the scale and the spread and all of that, which doesn't have any real tie to the intrinsic value of the asset. So unlike buying or selling a stock or a bond, this is the economic cost of processing a transaction. All right. So even if you have a high demand stock that would generate a huge fee in relative terms, the actual absolute fee it generates might be very small if it's a low value transaction. And it wouldn't make sense to actually lose money to lend that security for an agent lender. Hopefully that makes some sense. So let me just really summarize this for securities lending on price. So the general collateral or GC securities, they're widely available and they trade within a relatively narrow band. It's never going to be the same price because of all these variables that I talk about. I've had a question come in from Kartik. Thanks for that question. He basically says, is the collateral accepted based on the securities lending agreement? Yeah, there's a securities lending agreement between an agent lender and their underlying client where the client says this is the collateral that you're able to take. If it's done bilaterally or in tri-party, one way or the other, the agent lender communicates that to the borrower. And every time there's a transaction, the borrower will say, what kind of collateral do they take? And the agent lender will say, this is what it is. Now, that might change over time. And there might be concentration limits, diversification requirements. Clients might be okay with assets at one point and then not at another point. So it's usually done in a separate schedule, which can be amended over time. And then reflected in tri-party if that's the case. So that's a really good question. And that's really a good example of the variability. That's the variability by client of their collateral selection process. And look, a key issue that I think will become even more important, which I'll talk about next week, is the selection of ESG collateral and how that might add another layer of complexity as investors get involved there. Another really good question about using smart contracts. I think it's really early days for that. So the trade associations have been working on the definitions there. I think at some point that's an inevitability. But whether I have any hair left by that time or not, who knows? But definitely it's coming down the road. And I don't think it's as far away as some people think. And that's definitely the path we're on. If we go back to the second point here, not all securities are available for loan and all the would-be borrowers because of the credit consideration. I know I keep coming back to this point, but this is a massive differentiator. And so even if you have credit limits, a borrower has a limit for the lender has a limit for the borrower, the agent lender that's providing an indemnity might also have its own credit constraints on what exposure they can have to the borrower. Because as you'll see in the indemnification video that I'll put a link into, the risk of that borrower going into default under the indemnification becomes that of the agent lender. So they also have potential credit exposure to that borrower. So there's multiple layers there. Okay, so not everything that looks like it's available that will be published in theory in future because of SEC proposals will actually be available to anyone. So the question is, does that make it a better market or not? And I'll come back to that. And the agent lender distribution strategies, this kind of intrinsic value focus or absolute return focus it differentiates, and most people operate somewhere in between that. We've talked a lot about the collateral transactions, the considerations on the size, the purpose of the borrower, even on the most liquid securities on GC. That's why you have a different price range. And so if you have price differentials at the most liquid end of things, of course, when you get to the less liquid end of things, the non-general collateral securities, warm, special, hard to borrow, there's a much wider range of trading prices. And many of those reasons are completely explainable and usually down to economics. So the bottom line here to me is that executed prices aren't really necessarily available or replicable by everyone in the market. So unlike an Apple stock, unlike an Apple share, which will generally be the same price to everyone that wants to do, that's not true for securities lending, right? Now, what prices are good for is indicating what the trend is. Are the prices trending up or trending down? Is there more supply in the market coming in, or is there more demand for the existing supply? So those are the kinds of questions. Okay, so how does securities lending measure up? The reality is, I think there's many layers of challenge, which is why you get this disparity in pricing amongst entities. And of course, there are more efficient firms and less efficient firms. So I'm certain there's an element of service quality and pricing and dynamism in there. The other issue is, look, if you are a lender in the market and you're lending at the highest price in the market, so on any given day, you're lending your Apple shares out for higher than anyone else in the market. What you're also at risk of is a borrower saying, that's too expensive, I'm going to refinance somewhere else. So on a given day, you could look like you're the best performer, but actually over the course of a loan, you might actually underperform because you've had the highest price. So there's a lot of nuance to this, a lot of art as well as the science of the numbers. Another question from a LinkedIn user: are any products available for microfinance, and what's the role of tokens in this? Look, again, I'll go back to my previous comments about smart contracts. This is still in the age of analog, really. Those things inevitably are coming, and we see the kind of idea of immobilization, particularly on the collateral space, with work being done by firms like HQLAX, where I think these things are trending in this direction. But it's very much a watch this space. So I hope that's answered your question. I could add to that there is, in theory, activity in Israel that is much more digitally driven, blockchain driven in terms of scalability. I don't know about that. There was a recent transaction between two German banks, Deca Bank and Metzler Bank, where they did actually a blockchain transaction. So it is coming, but fundamentally, even if two parties agreed today to do all of their trades between each other blockchain, the reality is most firms have 50, 75, 100, 200, 300 counterparties. And the transition time to getting all of those counterparties means that for the foreseeable future, you will be dominated by traditional lending activity, growing blockchain type transactions. But I think it'll be quite some time yet before it'll be predominantly a different form than it is today. Right. Where do things happen? The key for a borrower whose job is to get that security in that they need because there's a short sale. The reality is they'll do anything they can. They'll go anywhere to anyone under any terms they can. If it's a hard to borrow asset, they will scrounge and they will trade bilaterally. They'll trade on platforms. They'll send carrier pigeons. They'll do what it takes to get those securities because that's their job. And while trading platforms do offer centralized meeting places, there are additional costs involved inevitably in that, and they aren't always necessary for to execute. In fact, sometimes it would add an extra layer of time and complexity to it, whereas bilateral transactions in specific instances might be faster and more accessible and more efficient. And remember, not all of the lenders have arrangements in place, and borrowers, of course, but since this is demand driven, it's about lenders. And if a lender isn't on a trading platform, but has assets that a borrower wants to have, that borrower will do what it takes to get those assets. A lender doesn't necessarily have to be on a platform, although it's difficult to be efficient and scalable unless you, and that's why bilateral trading is commonplace. Standardization in the industry is still lacking. And I think it's a challenge to bring it into the market because all of this depends on the flexibility of the lender being able to participate in lending programs, but not having to commit their assets to it. The challenge that bilateral trading is still commonplace in the market, even though the majority of transactions go through trading venues, but standardization is lacking. And part of the reason that standardization is lacking is because counterparties, lenders in particular, want to be able to trade flexibly. They'll make their securities available if the lenders and the borrowers recognize that they need to get securities back when they need to get them back, whether that's to vote or because they sell or just because they want them back. And if you put more restrictive tenets in place saying you had to make securities available for a minimum period of time, trade settlement had to happen by this number of days, all of those sorts of things would make the market more standardized, but not necessarily more flexible. Okay. And flexibility is the key. In this business, if you're more flexible, you're more likely to make money. If you're willing to trade off flexibility for more constraints on what you do, often you can generate premiums from that because you're saying, look, I'm willing to commit to make my securities available for a fixed period of time, for example, and you might be able to get a premium. And so the bottom line for all of this is that although trading venues carry the majority of transaction volume, they have to, by definition, reflect the underlying bilateral credits between the end borrower or their prime broker intermediary and the end lender, because that's where the credit exposures are. Put a layer on top of that, and you still have the agent lender exposures. So it's not as straightforward as a cash market execution. Okay. So there you go. That's where they get done. I'm going to turn to the SEC proposals. This has gone on for a while, so I'll try to get through this, but this is really important. So not this past week, but the end of the week before, the Securities Exchange Commission in the US proposed a new rule to provide transparency in the securities lending market, where more reporting will be required if the rule goes through, be required to be made to the SEC, and some of that information will be public. And look, the report itself starts out, in fact, with the phrase, the securities lending market is opaque. So they have very much zeroed in on this particular issue, and it's one that they want to address. So that's what the chairman says. So that's what they are going to explore. This is interesting because this is a short consultation period. I think it's a 30-day period for consultation. So that's pretty quick, as I understand it. Right. Look, my view is regulators can ask for whatever information they want. We need them to stay on top of markets. We need them to make certain that there's no abuse. We need them to make certain the markets are as efficient as possible, whatever they determine they need to be proper stewards of market. And so I don't have a problem with that. And in Europe, the EU's regulation, the Securities Finance Transaction Reporting Regulation, SFTR, it has been super valuable for all of the market participants that have had to comply, and they all have a better understanding of their business now. I'm not convinced yet that the regulatory use of it has had an impact on anything yet. I'm sure that depends on which national competent authority you're talking about, as some have a better understanding of it than others. But it's not yet clear that there's value to the regulators, certainly to market participants. And so maybe the SEC they have some kind of a practical oversight issue that they think will be resolved by the securities lending data that they want to get. So look, I don't have a problem with that. Yes, it's a pain in the butt, and yes, it'll be expensive. They've tried to estimate the spending on it. It's an estimate, right? I'm not convinced they've got it right, but what do I? But look, there will be cost to it. To operate in a regulated market is costly. That's just a fact. So that's my view. And I have a lot of sympathy for regulators. I can see why not just regulators, but the public, particularly post GameStop, why the public wants to see more ticker like information in the market. I get all of that. The problem that I foresee though is that, whereas in buying or selling a stock, investors can get a pretty good idea of the cost of buying or selling that stock, they won't necessarily get that same value from understanding the value that they'll get from lending that security, or the cost to borrow it if they want to borrow. And they won't really know what the volumes are because of all these layers of complexity, nuance, and self-selection, I think, that I have been talking about. So that's what I see as a potential issue on that. And so really my question to the SEC will be, would publication of a securities lending ticker make the wider market more effective? And I guess there's a few things to say on that. Would lending or borrowing price disclosure bring more investors to market? I don't think so at all. Agent lenders are evaluating portfolios for investors all the time. Ones that aren't in the market, as well as ones that are in the market. But ones that aren't in the market, they are constantly reviewing that. So there's lots of people that know the value of their portfolio that, after hearing the value of the portfolio, decided not to participate in the market again. So I don't think, and on the borrowing side, so borrowing is an important element of the borrowing cost is an important element for would-be short sellers, but it's not the only cost. And so to me, I think more disclosure of information might bring people in at the periphery, but nothing fundamental. I don't think it fundamentally will make a difference. If we then ask the next question, which is, would it reduce the borrowing costs or lending revenues? Would it take that price disparity between what borrowers have to pay and what the different lenders are willing to lend at? Would it actually bring it into a narrower range? I think probably, but the other factors have more influence. And look, anyone that's already in this market, there is privately available data that everyone in the market gets, right? Everyone in the securities lending market right now that's at a certain scale, and it's not necessarily a high scale, they get that data today. And so they can see and assess where their pricing is relative to the rest of the market. So if it was just a matter of information, there wouldn't be the wide disparity there is today. So making that same information available to a wider audience, I'm not convinced that makes any difference at all. Maybe the worst price guide, maybe. And I already told you earlier in this episode why I think having the best price is not necessarily an advantage. The third question I'm going to ask is, are recent transactions indicative of executable prices in future? And so the answer to that is yes, to an extent. But the credit availability, the reinvestment risk appetite, the transaction size, the lender business, all of those have more impact than just the recent transaction prices. Okay. Again, I'm not convinced that that's but of course, again, let me just repeat, they are an important indicator of the likely future direction of it, because things tend to move in direction. Okay. So my summary is, look, I recognize that the information will be good and it'd be powerful and it'd be important for regulators to get, and that's potentially a good thing. But to me, my concern is that publishing this data to the public without these issues of context and collateral and risk and jurisdiction, all of that, I think it risks giving people the wrong information. If it shows there's 1 million shares of stock available to loan, first of all, agent lenders never lend out 100% of what's available. Secondly, many beneficial owners say never lend more than half of my position. Third, regulators have in place at a fund level for many different fund types restrictions on how much of a fund could lend out. So they might have the securities, they might be willing to lend them, they might be willing to lend them to the borrower, but they already have too much on loan and they can't make that loan. And so all of these factors, I think, could distort trading activity. People could think, oh, I can short it. Oh, look, I think I can actually, I can make some money lending it. That's not necessarily true. It's impossible to get this level of complexity of information into the public domain. And so I think it risks distorting real life liquidity and impacting markets in a negative way. So if the SEC wants the information, by all means, force people to do it, but think very carefully before you start publishing them. Just a quick pitch. Of course, we always talk about our securities lending courses, and that course in the top right corner, which I keep telling you every week is going to be done, isn't done yet. I thought it was going to be done. My weekends are too busy because I'm doing things like this. I will do that. I promise. I'll finish out. We've had a couple of people sign up this past week for the Introduction to Securities Lending course. So quite excited about having new students on that. And we have people signing up for the free primer all the time. Lots of course information there. Love to share with you, let you know what our thoughts are on securities lending. Let's summarize all of this stuff. Get it back up on screen. So securities lending is an important part of developed and developing capital markets. And I think that was included in Gary Gensler's comments, which is why it's important to them to get it right. It is a critical part of the operating of the capital markets. The market depth question, look, market depth, it has some visibility in the business today, but because execution is really totally reliant on credit relationships to be able to execute, the market depth information, even if it was completely visible, wouldn't necessarily have full value. Oh, I went too far. And the prices, the lending and borrowing fees that people pay is much more than the simple supply demand economics that you would see in a cash market. And yes, all of you who have seen loads of videos from me, the reality is I say all the time, securities lending is basic supply demand economics 101. While that's true to an extent, you can see with the layering that I've done here that there's many more issues. There's many more issues there. And Kartik, again, I agree. Too much information restricts the smooth flow of the business. And that's really from the trading end all the way through, as you say, to the operational process. Too many choices actually satisfies investor needs, but really constrains the business and actually adds cost to it and can actually make operational processes much more difficult. Trading venues, of course, they process a majority of the transactions, but again, the job of a borrower is to hunt down that security on the best possible terms. And whether that's via a trading venue or directly is a secondary concern. The need is to get those securities. And finally, with respect to the SEC proposals, the aspect of publication to me concerns me. I think it needs a lot more scrutiny. Obviously, there'll be a huge amount of commentary on it. And in my view, as it looks right now, wouldn't, to me, necessarily make markets better and would add additional costs and still not make the markets better and potentially worse. So that's it. Next week, I'm going to be talking about transparency again, except this time it'll be non-trading. I'm Roy Zimmerhansl. Thanks very much for doing this. This is much longer than ones I've done in a long time. Appreciate some excellent questions today. Sorry about the sound problem that won't be known to the people watching this on replay. Thanks for being with me this Saturday. Have a great weekend. Have a great rest of your Saturday. Have a great week, and I hope to see you next Saturday.